prices of banks, including some of our best-known local banks, dropped today as Wall Street worries about what may be next after the second and third largest bank failures in U.S. history. It comes after the collapse of two large banks, Silicon Valley Bank and Signature Bank.
Now, they are banks that specialized in loans and technology companies, and in the case of Signature of New York, was a leader in cryptocurrency lending. But smaller banks then started reassuring their customers today, and the big question remains, is your bank and your money safe? So joining us now is Chris Stivers. He's the chair of the U of L Department of Finance and PNC professor of banking and finance. Thank you for coming in,
You're
Chris.
welcome. You're welcome.
The big question, let's take that right off the bat. Do we all need to be worried about our local banks based on what happened to these two?
From a depositor point of view, I would say no, right? The government, the Federal Reserve, the Treasury, and the FDIC all stepped in, and the whole goal is to make sure people were confident in the banking system. So they put in place, of course, they have the 250,000 FDIC normal limit, but they declared this a systemic failure risk. So they're saying they're going to make all the depositors whole on Silicon Valley and these cases here, which should apply to any other failures that related. And then additionally, what they're doing is they are allowing banks to borrow on their collateral, on their assets, not at their market value, which is declined as interest rates have risen, but at their par value or their book value. So that gives them a much greater opportunity to borrow. What happened with Silicon Valley is, how much detail you want me to go into, but they had their deposits roughly doubled in 2021 as a lot of cash came in with the pandemic and all the support investments. And they needed to do something with that, so they invested a lot of it in long-dated treasuries.
Well, let's pick up on that. I know we had some more questions real quick for the retail banking here.
One that people are wondering is, how do Silicon Valley and Signature differ from our local banks right here?
Yeah, that's a big, you mentioned the tech aspect. Some numbers I looked at talk about Silicon Valley, which is the one I spend most of my time looking at. There are several significant differences. One is most banks have a significant amount of their deposit bases in retail customers, and that money's relatively sticky. It's not apt to get pulled out, and much of it is insured. So if it's insured, it's also safer, and people are less likely to feel like they need to make a run and withdraw their money. But Silicon Valley had a huge chunk of their money was from corporations. I saw one article that said Roku Technology, they had maybe $480 million in Silicon Valley, of course, uninsured. So they had big unrealized losses on their long-dated treasuries. They sold some, lost about $1.8 billion earlier this week, or actually middle of last week. They also thought, well, we're going to build up some reserves, we're going to issue equity. Well, that sounds like a thing, but if you're issuing equity, you're also signaling in the market you need capital. And the combination of those two things and some advisors advising people to pull their money, they had attempted $42 billion of withdrawal on Thursday.
Wow. On
a $175 billion deposit base. So that's like 24% of their deposits tried to be withdrawn in one day.
So
So the difference is,
yeah.
They had like maybe 10% of their money in retail deposits, where a more typical bank might have 40, 50, 60, even more percent, much higher percentage. Very high percentage of their deposits were uninsured, where smaller banks, a very high percentage of their money is going to be insured.
So let me ask you something right here.
One other one too.
I just want to thank you for coming in and appreciate letting us know that we can be reassured about our local banks.
Yeah.
Chris Stivers from U of L. Very good information. We appreciate it.